Hey everyone, this is a little introduction about SFM, Strategic Financial Management from your CMA final, of course. SFM is mostly about capital assets and capital expenditures, as we know, and every finance professional or a finance manager has to go through three decisions: investment decisions, financial decisions, and dividend decisions. First one is investment decisions. If the investment is made in fixed asset, then it is called as capital budgeting. And if the investment is made in current assets, we term it as working capital decision. For example, purchase of raw material. And the second one is financial decisions. It is mostly concerned about where to get finance from or the funds from. For example, GDR, ADR, FDI, leasing and hire purchase, etc. The third one is dividend decisions. Part of company's earnings, that is profits, will be distributed to the shareholders, and for preference shareholders there will be some fixed percentage of dividend to be distributed. For equity shareholders, the percentage can be decided time to time, which can be changed from time to time. Board of directors decide the dividend percentage. Members can reduce the dividend percentage, but they cannot exert their power to increase the dividend percentage. At a certain point of debt and equity, the value of business increases, and beyond that, the value decreases. For example, if the profit is 10,000 and the equity is 1,000, then EPS will be 10, EPS as in earning per share. But when equity is 2,000 and profit is the same 10,000, which is 10,000 by 2,000, then earning per share is reducing, which will be 5. Hence, we can say that debt and equity at a certain point will increase the value of business, and beyond that, or more than that, the value will be decreasing. What happens when debt is higher than equity? There are two scenarios. The first one is when the debt is very much higher than equity, the financial cost burden will increase, which will lead to deduction in the profit, which means you have to pay the interest for the debts. The second one is when the debt is higher, there is higher chances of insolvency. What happens to market value when dividend is given? As per theory, market capitalization is constant. But according to other theories, when dividend increases, market capitalization increases. When dividend decreases, market capitalization decreases. What are the major differences between equity and preference shareholders? The first one has to be the percentage difference in dividend, and the next one will be during the liquidation time, more preference is given to the preference shareholders. Do shareholders invest for dividend? No. Shareholders don't necessarily invest for dividend because they are very meager amounts. They invest because they want appreciation of shares. It appreciates only when company has investment plans for retained earnings. Finance professionals mostly focus on balancing and finding the ideal portion on how much to invest and how much to give as dividend. If EPS and DPS are equal, that is, EPS is earning per share and DPS is dividend per share. For example, EPS is 10 rupees and DPS is 10 rupees, then what will a shareholder see? It will impact in a negative sign. It indicates that company has no future plans or it won't grow further. It is a negative sign, as I said, and it will lead to a decrease in share price. In another case, if EPS is 100 rupees and DPS is 0, this will also lead to a negative sign for the shareholder because that means there will be no dividend. What is the difference between project and program? Project will take example as L&T, and for program we can take example like vaccination for the whole country. The three main important factors which determine if it is project or program are cost, time, and task. Because in a project, three of these cost, time, and task will be determined, will be specified. Whereas in programs, it is always based on the end result. There will be no time constraint or cost constraint, there will be no barriers for it in the program. In this, there's also a concept of time overrun and cost overrun, which means if the time of a program is increasing, then the cost of a program will also increase. Before going into project implementation, there will be some feasibility study which should be conducted. There will be many parts of it like technical feasibility, market feasibility, socio-economic feasibility, financial feasibility. Out of all these feasibilities, only financial feasibility will be taken care by finance professionals, and all they have to do is justify if it is going to give proper return on investment. Just like how we choose a course if it's going to give proper package or placement. This is just a little introduction of all the topics. I'll upload more later on.